Hey everyone, it's Mike Andes, and you're listening to the Business Bootcamp Podcast. Today we're going to be talking about how to buy a business, what you need to be looking at in the business financials, and what are the telltale signs of a bad buy when it comes to purchasing and acquiring another company. Before we jump into that, a big thank you to today's sponsor, which is Gusto. I know so many of you, I've heard from you, and how many of you have tried this trial, the 90 days, and have already continued to use the software going forward? The amount of people that are signing up for the trial to the people that actually continue to use the software afterwards is tremendous. The reason is because it's a full-fledged HR system. Everything from your payroll to your benefits to tracking everyone's time off. It's absolutely fantastic. If you haven't already, I guarantee you it's worth a shot. Give it a try at gusto.com. That's gusto.com/bootcamp and get a three times the amount of a trial period. Everyone else gets a 1 month on their general site. Listeners of Business Bootcamp Podcast get 3 months, 90 days trial of their software completely free. Check it out, gusto.com/bootcamp. Now, I know I've been offline a little bit recently, and that is because not to my own doing, but some of our sound equipment here got broken. I had to send it in, and so it's getting fixed right now. Zoom is the company I bought that equipment from, the sound mixer and things like that, and I have to say they have a fantastic customer service and return policy. Some of the buttons and things had broken just really kind of instantly, and nothing major happened, but just kind of broke randomly, and they took it back, no questions asked, and are sending me a replacement. So shout out to them for good customer service. But that is the reason why it might sound a little bit different. My voice is also very I've kind of had a throat thing going on, coughing like crazy. So if it sounds a little bit weird or different, my voice, that is also the reason why. So a little bit raspy the past few days. Anyways, I want to jump into today's show, jump right into it. Today won't be long, but I want to kind of go over a question that I received recently about buying a business. So I've probably got 2 or 3 of these in the past month, so I want to address it. If you haven't got an answer from me, this is probably it. I've made a note for a while that this is a question that I wanted to answer on the podcast. I'd made an episode on this a while back, probably a good year and a half, but I wanted to kind of readdress it after I've done more and more of these and seen more and more acquisitions of listeners and people that have brought me in to consult during times of acquisition, and as well as transferring people and getting everyone on the same business model. And so I want to kind of give my 2 cents on it. This is not a comprehensive episode. I could literally spend 2 or 3 hours going very detailed over exactly what should be going on when you're buying a business and what number, how to really do an evaluation and things like that. I think maybe one day we'll do a live webinar with everyone, and we can really pour over some numbers, some P&Ls, and really dig into some numbers, because this is a question that has popped up quite a few times. And so, first of all, the biggest question for everyone that wants to buy a business is what price is right? And so everyone's trying to find the magic way to evaluate or put a valuation on a business. And so the thing is, every industry is different, and it's very, very difficult. And literally, even if you talk to a quote-unquote professional valuer, asset, whatever you want to call them, they call themselves, you can talk to one, and then you talk to another one, they have a number that's 5 times as much. Like, literally, it's just all over the place. And so I really think that the business owner, if educated, and I don't mean educated as far as going to school, I mean if they are informed, that's the word I'm looking for, informed enough, they are really the best person to make the decision. They know the business, they know the industry, hopefully, and they can make the best decision for them and their company going forward. So obviously there's some really easy equations that people have used in the past, things like 3 times profit plus assets. So for instance, if a company is doing $500,000 in revenue in a year and they're making $100,000 in net profit, bottom line is $100,000. Someone would say, okay, 3 times profit, that's $300,000 plus whatever assets the company holds. So let's say the company has $200,000 worth of assets. So at a $500,000 a year in revenue, they're making $100,000 in profit. Times that by 3 is $300,000, plus their assets is $200,000. So that's $500,000 is the valuation of that company. So that's the 3x profit plus assets model that is used a lot of times But like I said, every single industry is different. You look at tech companies and it's 10, 20 times that amount. There's companies that are making negative net profit and they still have billions of dollars worth of valuation. So it's really not all about value of assets or even your profit margin when it comes to valuing a company. So I want to talk about some of the things I look at. So this is going to be completely different than what if you were like looking at tech companies or you were doing angel rounds or if you listen to Shark Tank, things like that. There's other sort of metrics that they are using, especially when it comes to Silicon Valley and the like. They're looking at one of these things, and that's the first one I'm going to talk about. But I'm going to talk about several of the factors that I look at when I'm looking at landscaping companies that we've bought out. We've done 3 acquisitions personally, and I've probably been involved in probably 10 to 15 acquisitions of listeners and different people on whether it be from my landscape business course or just from consulting from Business Bootcamp podcast. And so just being involved in that process and knowing what to look for is something of value, I think, for many people. I've never done an acquisition over $1 million. That's obviously one day will come in the future, but I've been involved in a lot. Many of mine are in that smaller range, less than $1 million. And so one of the biggest things that really is the driving force of valuation when it comes to any business is the scalability of the model. So that's why tech companies have incredibly amazing multipliers of their revenue when it comes to their valuation. So they might make, let's say, $10 million a year, yet all of a sudden they're valued at like $1 billion. So it's pretty incredible. Like literally, it's 100 times their net profit, the value of their company. And so what's interesting though is the reason they're valued at that is because it's scalable. It's online, it's technology, it doesn't require a lot of infrastructure, it can scale very quickly within a couple years. Airbnb can scale massively in just a matter of a few years, and their valuation can literally go from 0 to $1 billion in just a matter of months because the internet, because technology is very, very scalable. That's why angel investors, venture capitalists are so interested in the industry of technology and how to make things revolve around technology and the internet, because it is so easy to scale, it's very cheap, and it is very cost effective. So number one thing that I look at is the scalability of a business model. How is the company set up? The business model, is it unique and is it scalable? Whether they're using technology or they have some sort of unique advantage, whether it be a patent or some sort of technology or even people can be a scalability, like whatever it is, what about their model makes it scalable across the entire country, across the entire world, across many different types of markets. So for instance, scalability for Airbnb, I'll just take them as an example. They can scale basically across the whole world as long as there's enough users and enough people offering the rooms. And so they can basically go from one city to the next city to the next city and just continue to dominate markets. And scalability is inherent in the model because you have users and then you have the people offering the services of their bed and breakfast. And so that's the first thing I look at in a business when I'm looking about acquisitions is scalability. And really when it comes to valuation, that's what everyone's looking at is scalability. That's the main driving force. The next thing I look at is people. So when you acquire this company, are you getting the people that currently work there? So are they really experienced? Do they know the market better than anyone else? Do they have some sort of unique advantage over anyone else you could possibly try to find in the marketplace for like the labor market? For instance, if I'm buying a landscaping company and I'm buying it in a market I'm not really familiar with, I don't know which streets are good, I don't know the mayor of the city, I don't know all the other business owners, and I need someone that is a little more aware of that market, I'd be very inclined to try to buy a company before going into that market and just buy a company outright, pay a little bit more than I would if I just did marketing myself, but I try to cut out time by having the right people on board, trying to get the owner to stay on for a year or something like that, and try to make that transition into the new market, trying to make it a little more smooth. So people is very important. Are there people that are very educated in that industry that you're in, very experienced, have lots of leadership role, responsibility, and experience in that in that business, and really, like, could you not run the business without that person? That's really come back to scalability too, is if you don't have systems in place, if you don't have procedures in place, and everything is relying on the business owner, that the valuation of that company drastically is reduced. The reason for that is because any potential investor that looks at that, whether it be someone buying the company or an angel or any sort of investor, potential acquirer of your business, is going to see it as you as the bottleneck. And if you were removed from the company, all of a sudden they realize that the company would fall apart. So that's why I push so strongly that everyone creates a systems centric business model that is governed by systems and procedures and not by your strong personality, because scalability, systems are scalable, people are much harder to scale, and your expertise and your level of experience is much harder to scale than is systems, procedures, technologies, etc. So that goes back to the people part too. But when you're acquiring companies, sometimes an individual that is going to come on and work for your company going forward as part of the acquisition is of value. And you see this especially with startups within the tech industry. People will get bought up for ridiculous amounts of money when they're not making any, they have no traction. They don't but they might have a cool product or a cool website, but literally within a year or two, that company is basically wrapped up into nothingness. And it's very clear that the acquisition was based really just on hiring the talent acquisition is what it's called. They basically buy the business so that they can hire the people that work there. And so this is a new phenomena. It hasn't really happened for decades, and so it's still going to pan out to whether or not this is a really a viable way of acquiring companies just for the people. But for small business owners, this is a rare thing to buy a company just because of the people, and it very rare, unless you're doing technology. So but people are still important. They're important. Like I said, a landscaping company, whenever we do this sort of thing that I've been involved with, this is the most common one, is to have the landscape business owner that is getting acquired, have them stay on for 1 year. And if they're really amazing and know the area and the market like the back of their hand, there is value to that if they are willing to stay on and work for you. And so that has to be really taken into consideration when you're looking at the value of the company. Next thing, the third thing I look at is inefficiencies. So this is what I love. This is where the entrepreneur side of me steps into play, is the inefficiencies. I look at the systems and the procedures of the business, and I'm looking for where, okay, yes, they made 10% margin last year, but can I make it 12? Can I make it 15? Can I save 5 minutes for the cruise? Can I make the internet connection a little bit faster, the website experience better, the e-commerce platform smoother experience for the customer to increase sales? Can I make the system more efficient? So again, this goes back to the whole thing of systems. If a company doesn't have systems in place, I can't look at it and see how I can tweak it in terms of efficiency, because it's very hard to tweak people's personalities. It's a lot easier to tweak systems and procedures. And so if I look at a company that I'm wanting to acquire, I'm looking for systems and procedures, and then I'm looking for the inefficiencies in those systems to see where I can squeeze out more dollars and make it more efficient, have a higher profit margin, and also look for inefficiencies in their processes as far as sales, closing sales, marketing, things like that. Are there gaps of opportunity that they are not seizing and they have a unique advantage to that I can't get right away? And is it worth paying a premium to them for that, and getting their model and then making the efficiencies there so that you can squeeze more dollars out and you can make it more efficient and you can really scale the business more. So one big problem I find with entrepreneurs, especially landscape business owners that don't know about valuations, is they look at the inefficiencies, because as entrepreneurs we love to do that, and they say, I can make it better here and here and here, and there's so much opportunity here, and I could grow into this market, and I could add these services or products. And they look for the inefficiencies, and that's the entrepreneur side of them. And then they go and make their valuations. What they do is they say, okay, yes, right now it's only making 10%, but I can make it 15%, and so I'm going to do my valuation based upon 3 years worth of profit, and they use the 15% margin instead of the 10% margin. So what I'm saying there is don't use the numbers. This is a warning on finding inefficiencies within the business. A lot of people will find inefficiencies and then use that as leverage to make their decision and say, oh, well, I can just, save more money here, or I will be able to, because I bought the business, it's going to make 50% more in profit next year. Like, it didn't just happen like that. You got to actually make changes and things. But even if you see the changes, don't base your valuation on tomorrow's expectation of profits, or tomorrow's expectations of growth, or tomorrow's expectations of revenue. Base it upon today's stats. Look at the P&L and base your valuation on that. Don't look at it and be like, oh, well, it's going to help us grow here, or this better market, or more product, whatever it is. Don't look at those things. Base it upon today's numbers, and I promise you'll look at the valuation a whole lot differently, because it's very easy to look at any P&L, even ones that I've seen that are horrible, and you'll look at them and say, you see the opportunity, see the ways that you can make it way more efficient, see where they're spending, the previous owners are spending too much money on certain things like yellow pages, or like print in the newspaper, or banner ads like on Google, like whatever it is. You see the inefficiencies, see where they're spending money they shouldn't be, or see where there are inefficiencies in labor and the processes, and be like, oh, well, this is great, I can make this work, and then go make your valuation based upon the future expectation of those successes. Do not do that. That is a big risk. Us as entrepreneurs love looking for inefficiencies within any business. Like, I walk into any business, every business I come into contact with, I'm like going into it as if I'm trying to fix it, or like look for the problems, and then also looking for like, where are they doing really good, what can I learn from them as far as customer service, what can I learn from them as far as how they deal with their people. I look at every restaurant I go to, every company I call, like phenomenal versus horrible and everything in between, and I'm looking at it like that all the time. I'm an entrepreneur, and that's what entrepreneurs do. And so the problem with that is we get to a company that we want to acquire, and we start looking for those things that we can change, that we can tweak, that we can make more efficient, that we can squeeze more dollars out of, and then all of a sudden we make the numbers work for the acquisition. So that's a very slippery slope. That's the third thing, inefficiency. So number one is scalability of the model. Number two I look at is people, and if they bring value to the company. Third is inefficiencies. The next thing I look at is a competitive advantage in the marketplace. So basically, I almost look, okay, for instance, if I'm going into a new market, if I can buy out the person that is currently number 2 or number 3 in that market, for say, let's say you're doing cabinets and you're wanting to move across the country, and you're going to buy out another existing cabinet company instead of building up your own, because building up your own might take 3 or 4 years to generate a steady income. So you say, okay, I'm moving across the country. And what you could do is go in and buy the second or third largest. The first one's probably dominating. They're doing really good. You're going to be paying a very high premium. They're probably wanting to grow and expand. So let's go up to the second or third third contractor in the market, and you want to buy them out. And so what you're going to do then is say, okay, is it worth buying them out, then pouring the fuel of my experience on that business, seeing the inefficiencies? Can I get a competitive advantage in a certain market? For instance, we have bought into the south part of our county. So a couple years ago, we were mostly in the northern part of our county as far as service area, and so we wanted to move out in the south part of the county. And a year later, after the acquisition, we ended up building a shop down there because the market has grown so much, and it was a good decision for the acquisition. However, back before the acquisition, back before we started the second shop, we looked down in South County, and I was like, okay, well, we can spend a bunch of money going into it. It'll take us a couple years. We'll have to spend a bunch of money marketing. We won't make any money on the routes, because we'll be driving all the way down, 30, 40 minutes away from our core area that we currently are located in. And so, there's not going to be much efficiency there. And so I said, okay, well, let's buy into the marketplace. So I went in, bought a small landscaping company that was in the southern part of the county. So instantly we had pretty dense routes, enough routes to make money, and when a mowing crew would go through, enough mowing clients to get our name on trucks that are driving around all around that area, to get the word of mouth, and to get people start clicking the website from that area, and so it gets higher in Google, etc. So now fast forward, a year later, or well, actually that would have been two years later. So 2 years later from that acquisition, And now we have a second shop down there. We rank, on the first page, if not first, in that city's name with landscaping and lawn care behind it. So it was a good acquisition, and it was because I bought it for a competitive advantage in the market. I still got it for pennies on the dollar because the owner was going bankrupt, so I was kind of able to take advantage of that. I still gave him a decent amount of money, probably more than most people would have, but I still feel like I got a really good deal on it because I had a competitive advantage. I was able to go into a marketplace that I would have otherwise had to have broke even or lost money on for a year or two, and was instantly able to get revenue, which thus in turn gave me a competitive advantage because I was able to go into a marketplace and dominate right from the get and show my competitors that I meant business. It gave me a competitive advantage in the fact that we offer retail and services and no one else in that market does, so we were able to go in there, use our competitive advantage, and really step it up. So that's the fourth thing I look for when I'm coming to evaluate a company for acquisition, is a competitive advantage. Do they have something I need to dominate the market? The last thing I would talk about, the fifth thing that I really stress so much, and sorry about my voice, it sounds strained, and it is. It's just I haven't been feeling very good, and it's just been worn out by talking so much and stuff. But anyways, so the last thing that is the most important, number one, the absolute most important thing you got to do is to study the P&L, profit and loss statement, and find holes. So the reason I talk about this is because these massive broker deals, when you get a broker involved, a lot of times they're going to bring in accountants, lawyers, etc. They're going to do this part for you. They're going to tear apart the books. They're going to look at taxes. They're going to look at tax returns. They're going to look at receivables. They're going to look into bank accounts. They're going to really make sure everything lines up. The problem is when you're doing deals that are under $1 million, a lot of times it doesn't even make sense to get that many people involved in a deal, like brokers and agents, and you got lawyers and accountants, and just about everyone wants a little bit of the action. And so what happens is that gets really expensive. And so for these smaller deals, especially when you're buying companies that are only like $100,000, $200,000, it's really not worth trying to get massive amounts of lawyers, agents, and people, accountants, because you'll spend just as much on them as you will acquiring the company. That being said, if you can get a local accountant or lawyer to look over an acquisition, I highly recommend it. Sometimes you can get it for a few $1,000s and have someone at least look over things. But that being said, I think still you as a business owner, this is still my most important thing, is study the P&L. For smaller deals where you're not getting a massive amount of professional help, or you can't afford it or whatever, especially if these are this happens a lot, $10,000 to $50,000 deals of companies that are really just kind of selling their assets in their name or their website. Don't just walk into it. Study the P&L. And what I'm talking about is find holes. And you're like, what do you mean by that? So first of all, I'd look for an inconsistent chart of accounts. So chart of accounts is basically just the categories of accounts or different categories of expenses. So you're looking through, you're saying, okay, how much they spend on marketing, how much they spend on office supplies, how much they spend on gas and fuel, how much they spend on travel expenses. And then what you want to do is look for inconsistencies. You want to look for the 1 month they spent $5,000 on travel according to their expense list, according to their P&L. And ask them, what was that about? Find out. Maybe they all of a sudden took a personal vacation and put it all in the business. That's a telltale sign. That can indicate something. Not necessarily always bad, but it can mean something. Looking for inconsistencies like all of a sudden there is $15,000 all of a sudden spent in a week on marketing when it hasn't been spent for 3 months. Nothing's been spent. What is that $15,000 expense? Why was it spent? Was there ROI on the advertising campaign? What was the advertising campaign? Was it a good piece? Was it a bad piece? Was it a print ad? What kind of marketing are they doing? Dig into the P&L and find inconsistencies. Wherever there's big peaks or valleys, you want to question the business owner and get the answers. I'm not saying question as far as doubt them, as far as whether or not they tell the truth or their honesty or integrity. You just need to know. You got to ask these questions. They might not be easy. Things like, where'd you go on that vacation that was $5,000, and why'd you consider it a business write-off? And because if they're doing that sort of thing, there's probably other things that you might it'll raise your awareness. I promise you that when you start finding holes in a P&L. And one of the other things is taxes not paid. That is a huge deal for me. I look at so many landscape business owners P&Ls. I look at so many small business owners, especially in the service industry, where they got to self-report their sales tax, and all of a sudden their sales tax is at like 2 and 3% of revenue when they should be paying 5 to 10% in sales tax, and all of a sudden that number's at 2 and 3% of revenue, and you got to ask them what's going on. So maybe they are doing something where people are doing resellers permits, or they're doing some sort of tax thing, and that's like okay in their industry. But I find so often with business owners is when I'm looking at their P&L, it's their taxes. I'm like, something's wrong. So definitely ask for their tax receipts for if they report quarterly or monthly or annually, depending on where you live and what size of company you are. Usually it's monthly if you're a corporation, that you're submitting those and those articles of declaration or whatever you call them in your state for your taxes. Ask for those, because it's and make sure that the revenue that they report is corresponding with the profit and loss statement, is corresponding with their tax statement, is also the same things showing in their bank account and the cash flow. Looking for those inconsistencies is super, super important. Find those holes, and when you do find the holes, question them and question them and question them. This is very valuable when it comes to negotiation. So when I do find holes in a company, and there's always some holes, like little holes is okay. You're looking for the big holes to, like when I say big holes, I mean like they don't pay their taxes, they spend money frivolously and like write things off they shouldn't, or like it's inconsistent as far as they're not doing a very good job of tracking stuff. Like that's not very good, because you don't even know if the numbers you're looking at are consistent or real, and especially if their bank statement doesn't line up with their P&L. That's just not good. And so those are the big holes. If the big holes show up, it's an instant no. If I can't think they're honest or have integrity, it's just an instant no. Those are big holes in their P&L that show that I cannot do business with them. I cannot buy their company, and it's going to end to bad things in the future. But if you find little holes, it can really help you with negotiation. Things like a vacation that was accidentally put on the business instead of the personal business owner's expenses. Things like paying off equipment late and not showing it. Little things that they mess up on. The reason for that is because if you can find it, they know you've looked into the books, and they're gonna tread carefully. They're gonna give you straight answers because they know you're looking into things. They are going to, if you can show that you're doing homework on everything they're saying and vetting every answer, going and looking at records online and looking at the tax stuff that's public and looking at their comparing their bank account versus their cash flow versus their P&L, looking at all of those things. If you can prove that, they're going to give you straighter answers, and they're going to realize that you mean what you're talking about. And I always do this, and this is kind of a negotiation tip, is leave one little hole right until the very end when you make your offer. Present that hole so they kind of get on their heels as far as like, oh man, I can't believe I messed up on that, or I can't believe that I allowed that to slip in the chart of accounts, or I forgot to balance that or annualize a certain expense, or put in the depreciation onto the P&L or something like that. And I leave that right before we talk about the offer, because I'm usually obviously going to try to get the best deal I can, and I can use that as one of my negotiation tactics, or like ways to make sure that I have the upper hand in the negotiation. So that's what I would say as far as studying the P&L, finding holes. And the last thing is kind of a thing when you're looking at the P&L is look for large ticket asset items. So things like trucks, vehicles, property, equipment, buildings, things that cost a lot of money, that are assets that are going to fall in the asset category and bump up the valuation. However, it is an expense on the P&L. And so the reason I talk about this is some companies will be fine and dandy and going along, buying as they need, and just kind of getting decent amount of profit. But then when they know that they want to sell for 2 or 3 years, they might not buy trucks or equipment or fix big pieces of machinery, or they might not build or repair their roof because they know they're going to sell. So realize that if there's a trend that in the past few years they haven't made these big asset acquisitions, or they haven't made these big investments in the company that are necessary for growth and are going to be needed in the next couple years, realize you got to take that into account. So I would really look at like the spikes, look at the high ticket items, look for those things that would usually cost a lot of money. Big piece of equipment, trucks, like I said, property, building out facilities and shops. For instance, like this past year, we invested a whole bunch in a second shop. Like that's going to obviously change the P&L and the profit statement and the profit loss statement, and just like how much money we actually made. Net profit last year was going to be less because obviously we invested in the company. Perhaps if I was looking to sell it this year, I wouldn't have done that, and that would have thus improved the looks of the company as far as from a profit standpoint, but yet I wouldn't have had that asset. I wouldn't have had the growth opportunity in a different marketplace. And so there's definitely, you got to look at the trend of when they've been buying things, and if you're going to have to make a bunch of capital investments in the next couple years because they've been pushing those off, knowing that they're going to sell the business. So those are the 5 things that I would do. If you're trying to determine the value of a company, there's absolutely no silver bullet. There is no equation, in my opinion. Yes, there are different factors for different industries. For instance, tech, there's certain types, like from landscaping, there's a 5x multiple, or there's a 3x multiple, or some industries are like if you're in oil and gas, it's like a 2x multiple, or whatever it is. Every industry has their kind of like quote-unquote multiple, but every single industry is also going to have someone that comes in and disrupts it, becomes a technology company, or has some sort of unique advantage, is valued, is much, much greater or much, much less, whatever it is, than the marketplace. So there is no silver bullet, but I would look at these 5 things. Scalability of the model, what type of people they have, and the people that you will acquire with the acquisition of the business. Third thing to look for is inefficiencies, and how you can make more net income, how you can make the systems more efficient. And the note of caution on that is don't make your valuation based upon the best case scenario. Make it based upon like today's numbers, present day numbers. Fourth thing is look for a competitive advantage in the marketplace that you are trying to expand into, or things like that. And fifth thing is study the P&L, find holes, and I promise you that will help you in your valuation process. If you have a business that you want to buy and you would like to come on the show, or even just email me and ask me about an acquisition you have in mind, throw the numbers past me. I want to see if your deal is worth it. You can email me at businessbootcamppodcast@gmail.com, or just go to businessbootcamppodcast.com, enter in the apply section, and fill out the form there. Again, thank you so much. This has been Mike, and you've been listening to Business Bootcamp Podcast. Until next time, be great. Nothing else pays.